Hey everybody, welcome back to the And Asset channel. I'm a wealth coach here at Better Wealth, and today we're going to really look at what people think whole life insurance does versus what it actually does. So really, I'll say whole life insurance, really life insurance in general, is probably one of the most misunderstood financial tools out there. Some people hate it. Some people oversell it and love it too much. And most people, I'll say, are just reacting to what they think whole life insurance does, not necessarily what it actually does. Something they heard somebody say, but they don't really know for sure. They're just going off of maybe they found something on the internet, read something, and now that set their whole mindset around it. So in this video, I really want to back the conversation up a little bit and help everyone get an understanding of what life insurance truly is. Because I'll say whole life insurance isn't good or bad on its own. It's really just a tool. It only works or it fails in the exact context of whatever your situation might be. I could look at, hey, this is the perfect policy, perfect design for one person, but it's going to completely fail another person because it wasn't what was right for them. So we have to look at everything within the context of this situation. So I'll say when it's misunderstood, it can look expensive, restrictive, inefficient. But when it's understood, you'll see how it can become a really good tool for stability, flexibility, long-term control. So here we're going to really talk about what it actually is, what it's designed to do, and why it can work really well for some people and maybe not be right for some other people. So we're going to look at first what most people look at and evaluate life insurance on. Most people probably evaluate it the wrong way. They ask, is this a good investment? What's the return? Could I get a higher return somewhere else? I'll say those are fair questions. You got your finances, you're looking to grow them, but they're just the wrong questions. Whole life insurance is not an investment. It's not the investment that you're going to put money in and it's going to grow. If we're looking at investment as, hey, we're looking to get the most growth that we can in the traditional investment in finance sense. And so it's not competing with those assets, the stocks, the real estate growth assets. It's really a long-term financial contract that's designed to provide certainty. So you get the reliability, also get liquidity if done right, and then optionality, which is going to be key to a lot of people. So if you judge it like a stock, it's going to look really slow growth. Where if you judge it like just a savings account, it's going to look expensive because you don't have all the money, especially early on. But when you judge it for what it is, how it can be a good growth asset, it's going to grow. It's going to have guarantees to grow, but really more of a controlled asset inside a part of your overall larger financial plan, you can see the value becomes a lot more clear. So whole life insurance shouldn't be, it's going to go out there, beat the market, do all of those things, but it can change the behaviors and help enhance what you're already doing and be a key foundational piece. So with all that said, let's dive into just the common misconceptions. And we'll start off with probably number one is just whole life insurance is just too expensive. So one of the most common ones is, hey, they say it's too expensive, and they probably have looked at pricing. You've looked at something you heard online. Yeah, you don't need whole life because it's way more expensive. And I'll say if you're comparing it to term insurance, definitely makes sense that you would think about it that way. But that comparison really misses the point. You're not just buying insurance. So we're not just going out buying insurance. You can. I know most of the people that come to us, we're looking more at the cash value, how it fits into the overall plan. And so, but you're not just doing that. We're looking at reallocating capital that you might have sitting in just taxable savings that's getting a slow growth rate, whether it's idle cash that you have that could be doing something more, or it's just conservative assets that you want to have where you can still have access and control. So think, hey, we're repositioning part of your portfolio that would otherwise be the fixed part, a bond type thing that you can look at. So the better question isn't, hey, is whole life expensive? It's what job is this money doing today? And that's the difference there. If we look at, is whole life more expensive than term? Absolutely. I mean, you're going to pay, if you look at the same death benefit, a lot more, but that's not really what most people are looking at. We're not looking to just buy a death benefit. We're looking at doing a lot of other things with it. So if the job, I'll say, is maximizing short-term returns, whole life will disappoint you. That's just going to be it. If the job is long-term certainty, liquidity, and control, it can be extremely efficient. And then over time, outpace savings and especially growth-wise during that time. Yes, even high-yield savings. I know right now interest rates look great, but if you look out over even 10, 15, 20, especially longer, then it's going to outpace those high yield savings accounts there. So whole life looks expensive when you treat it like term insurance, but it can become powerful when you treat it like foundational asset, reallocation of cash, and of course, number one, that death benefit there. So we're encompassing all of those together. So that's number one. Misconception number two, that you're locked into it forever. So another common fear and what I hear a lot is once you start, you're stuck paying forever until the day that you die, or maybe until age 100, age 75. But here's the truth. Base whole life policies do have required premiums. So that part's definitely real. And even those policies, eventually, you can look at stopping funding. You don't have to pay forever. But especially when a policy is intentionally designed with lower base, lower minimum, and designed for cash value accumulation, there's far more flexibility than what most people would realize. So depending on the design, many policy owners, you can reduce funding, meaning, hey, we only pay a little bit for a few years and then come back up. You can pause additional contributions, say, hey, going through tough times, don't just reduce it, drop it to zero. Or you can potentially stop completely, make it where you never have to put any more in at all. And you can always, of course, it's building cash value. You have that cash value available that is there to you. So all of those are great options that you have. Now, does that mean that flexibility has zero consequences and you can just do whatever you want? No, but it does mean choices. You're not locked into, hey, here's $50,000 that has to go in. You may look at the illustrations that we put out there and say, hey, that says $50,000 a year and shows it for the next 30 years. I don't want to commit to that. Truthfully, you don't have to commit to that. There's a lot of flexibility there. Now, like we said, that does mean there are consequences if you choose to not fund, if you choose to make it paid up, or you choose to stop for a few years, but you have those options. So the real risk isn't just, hey, imperfect funding, it's misunderstanding kind of, hey, you're not locked into that perfection. You really have the control during that entire time. So that's number two. Number three, let's look at people here. It's a bad investment. So a lot of people out there look at life insurance. You look online, go to Reddit or Google it, whatever the first thing that's going to come up. And they say, yeah, whole life insurance is a terrible investment. And so you'll look at that and I'll say, yeah, probably agree with part of that because it's not designed to be an investment in I'll say the traditional sense. I know some people will comment and say, well, you are investing in it just like you're investing in yourself or you're investing in different things. But I'm talking the financial word for investing where we're looking to get high growth and there's risk and all of those things. That's what it is not. So it doesn't compete with those growth assets, but what it does compete with should be savings accounts, that idle cash, the bonds, the fixed portion of your portfolio, that safe part, conservative capital, and money that just needs to stay liquid and also stay stable. So it's really, say, not about being the fastest horse. It's about being the one that finishes every race. That's what it's there for. It's there to make sure you put money in. It's going to stay in there. It's going to have guaranteed growth, but you still have access the entire time. So the return, it's not just a number. We're looking for the highest number. It's really a return on the flexibility you have, return on access that you are always going to have, and return on just not being forced to potentially sell assets at the wrong time if you need access to that money. And so that's where it can come in and fit into the just overall part of your financial portfolio. Hey everyone, it's Justin Gartman, a wealth coach here at Better Wealth. And if you are a high earning professional, an entrepreneur, or someone who just wants more control over your money, we are offering something called a clarity call. It's a one-on-one conversation with someone like myself where we are able to walk you through exactly how overfunded whole life insurance could help you build a safe, liquid, tax advantage foundation for your wealth. No pressure or fluff, just real clarity on whether this strategy is right for you. So click the link in the description below or tagged comment and we'll walk you through exactly how we can possibly help you. Now, back to the video. Misconception number 4 now is you can't touch the money. You put money in, it's in there, it's locked away. You're not going to have access to any of the money. And I know we have a lot of videos here probably covering most of these misconceptions, but I want to have one video that goes over a lot of them. And I'll say that's definitely a big myth, especially when it's designed the correct way if you want cash value accumulation. So even if you have a regular all base policy, after a few years, you're still going to have access to the money, but if you have it properly designed for that immediate access, cash value accumulation, then you're going to be able to access it through withdrawals. So You can withdraw up to cost basis. Don't recommend that early on, but down the road could be a good option. Or, of course, as always, policy loans. So yes, there's a cost to doing that, but it's different than a traditional loan. You're not credit based, not going to be income dependent, doesn't come with a rigid repayment schedules. The policy itself, as you know, cash value, everything there is used as collateral. So you're not pulling money out, you're borrowing from the insurance company. That's where the cost comes from. So that's where it's definitely not, you may say, hey, you always have the access. Technically, there are those consequences of it. You do need to repay that loan, or there's going to be a cost, and that loan value is going to continue to build up. So that's a cost to doing that. It can affect the policy values. You borrow $100,000, had $1 million death benefit. Now that death benefit's $900,000 because you have that loan outstanding that would need to be repaid. And so also misuse can damage the policy. You start borrowing, never paying back, stop paying premium, and truly just borrowing and borrowing and borrowing. Well, of course, you could run into issues. You start to build that loan value up higher than your cash value, and you're going to have problems. Now, I'll say you're going to have to really be misusing it to do that. And that's where we help and make sure, hey, we want to manage it the right way. But when used intentionally, can provide liquidity without forcing liquidation. That's where we call it the and asset, because you can use it, keeps the money growing, and use that money somewhere else. So misconception number 5 now, it only works for the wealthy. I'll say, whole life insurance often associated with the wealthy families. I know on here we've talked about wealthy families who have used it, how it can be used, and say that's true. There's many wealthy families that use it heavily, but it's not because it's exclusive and something that's out there, it's hidden, and they don't want you to know about it. It's because it's predictable, but we want it done the right way. I'll also say just because we can use it doesn't mean we should use it the exact same way the wealthy families do. I like to look at it, hey, if you're a bodybuilder or a weightlifter and you're in really good shape on all these supplements, hey, maybe those supplements are good. Does that mean somebody, hey, just starting to work out should go out and use the exact same supplements? No, your heart probably couldn't handle it. And so that's where, same thing, the wealthy may use it one way. And so the plan is going to look different depending on where you're at, but it shows that it is a safe, predictable asset that can be there, and definitely not a scam is what you may see out there. Now, it can be used the wrong way, but that's where planning comes in, and you want to make sure for your situation, like I said at the beginning, the plan matters. One policy can be great for one person, but not so great for another person. And it just depends on exactly the goals and what they want there. So I'll say it's not about necessarily how much you put in up to a certain point. Now, we need to get to a certain point where it actually makes sense, but be putting in $500,000 or $50,000. A lot of times it's just going to be how it's intentionally designed and integrated into what you already have going on. So I'll say it's really to pull it all back together. Whole life insurance is not a replacement for investing. It's not some shortcut to wealth. You're not going to, hey, you start getting whole life and you will become wealthy. It's really a tool to help build a foundation, and you should be doing other things to really increase that wealth. And it can be a great part of that because of the liquidity, because of the flexibility. So it's not that magic solution, but rather the financial foundation, a good volatility buffer, a control asset, meaning, hey, you have control of this, something that's just going to stabilize everything you're doing for the long term. So when used correctly, whole life doesn't make your plan more aggressive. We're going to necessarily get huge amounts more growth, but it will make your plan more resilient so you can stay in the game and continue building wealth as you go. So that resilience allows good decisions to just continue to compound over time and give you even more opportunities. So I'll say, if you want to see how this can fit into your plan with real numbers, that's where I'll say the customization can matter. But understanding how this can fit in is what truly matters first. So once you understand that role, the entire conversation around whole life insurance can shift, and we can look at how this can potentially benefit you. So schedule a call today. You can talk to me or any one of our amazing wealth coaches, and we'll be able to see if this makes sense for you or truly if it doesn't.